Hey there, welcome back to Bull and Bill. If this is not a welcome back, make it by clicking the subscribe button. Today, we're exploring a question that's more important than ever. What are money market funds and how can they work for you? Whether you're saving for a rainy day, managing your cash flow, or just trying to make smart financial decisions, this video is your go-to guide to understanding these powerful yet often misunderstood tools. Now, you might have heard about money market funds and thought, isn't that something for Wall Street pros? Actually, they're incredibly accessible and practical for everyday investors like you and me. Let's unpack everything you need to know. Imagine this, you've got some cash you're not ready to invest in the stock market or tie up in long-term accounts. Maybe it's money for a down payment, a vacation, or an emergency fund. You want it safe, accessible, and earning something better than your typical savings account. Enter money market funds, a financial tool that does exactly that. But wait, let's start at the beginning. What exactly are they, and why should you care? Stick around, I promise it'll all make sense. Let's begin with the basics. A money market fund is a type of mutual fund. It pools money from a group of investors and invests it in low-risk, short-term financial instruments. These could include treasury bills, ultra-safe debt backed by the US government, certificates of deposit, CDs, issued by banks and credit unions, commercial paper short-term loans issued by reputable corporations to meet immediate needs, repurchase agreements, repos, short-term loans backed by securities. The magic of these funds lies in their balance of safety, liquidity, and returns. While they don't offer massive growth, they do provide a way to keep your money stable and accessible while earning modest interest. So, why do people love money market funds? It boils down to three major benefits. Liquidity. You can access your money quickly, often within a day. It's perfect for short-term needs. Stability. Most funds aim to keep their share price at $1. This means your initial investment stays intact. Modest returns. While the returns aren't groundbreaking, they're typically higher than a savings account, especially in times of rising interest rates. To truly appreciate money market funds, let's take a quick journey through history. These funds gained traction in the 1970s when inflation was high, and traditional savings accounts were losing their appeal. They offered better yields while keeping risk low, an attractive combination for savers. But things weren't always smooth. During the 2008 financial crisis, some money market funds faced trouble. A few even broke the buck, meaning their value fell below $1 per share. This created panic among investors. However, regulatory reforms introduced afterward added new safeguards, making today's money market funds safer than ever. Did you know there are several types of money market funds? Choosing the right one depends on your goals. Let me explain. Government money market funds invest primarily in US government securities. These are the safest option, making them perfect for conservative investors. Prime money market funds include a mix of government and high-quality corporate debt. They typically offer higher returns but come with slightly more risk. Tax-exempt money market funds focus on municipal securities, which can be especially attractive if you're in a high tax bracket and want tax-free income. How do money market funds stack up against other options? Let's compare. Savings accounts. While FDIC insured, savings accounts often offer lower interest rates. Money market funds can give you higher yields with only a slight increase in risk. Certificates of deposit, CDs. CDs may provide higher interest rates but lock up your money for months or years. Money market funds are far more flexible. Treasury bonds. Bonds are safe but require a longer holding period. Money market funds give you immediate access to your cash. Let's bring this to life with real-world examples. Vanguard Prime Money Market Fund, a popular option for those seeking a balance of safety and returns. Fidelity Government Money Market Fund, a favorite among conservative investors, focusing on government-backed securities. Schwab Value Advantage Money Fund, known for its flexibility and competitive yields. BlackRock Tax-Free Money Market Fund, ideal for investors wanting to minimize their tax burden. These funds cater to a variety of needs, from individuals parking emergency savings to businesses managing payroll and operational expenses. Now let's bust a few myths. Myth 1. Money market funds are completely risk-free. While they're incredibly low risk, they're not immune to market stress. Myth 2, they're just for wealthy investors. In fact, many money market funds have low minimum investments, making them accessible to almost everyone. Ready to invest in a money market fund? Here's what you should consider. Your goals. Are you prioritizing safety, higher returns, or tax savings? Expense ratio. Lower fees mean more of your earnings stay with you. Fund portfolio. Look for funds investing in high-quality short-term securities. Tax implications. If you're in a high tax bracket, consider tax-exempt options. Here's a pro tip. Keep an eye on interest rates. Money market fund yields tend to rise when interest rates go up, making them particularly attractive in a high-rate environment. However, when rates fall, returns may decrease, but the stability and liquidity they offer often outweigh this downside. So, what's the big picture? Money market funds are a versatile, low-risk way to manage your short-term cash. They're safe, liquid, and offer better returns than most savings accounts. Whether you're saving for a specific goal, managing business cash flow, or just looking for a financial cushion, they're worth considering. Thanks for joining us on Bull and Bill. If this deep dive into money market funds was helpful, be sure to like, comment, and subscribe. We're here to help you make smarter financial choices. Until next time, stay informed, stay inspired, and happy investing.